Looking away from the dazzling price movements for just a moment reveals something far more profound unfolding beneath the surface of the silver market. While traders and investors celebrated watching silver surge to close the week at an extraordinary level, mere pennies away from a psychological milestone that has captured imaginations worldwide, a critical document quietly emerged that tells a completely different story about what's actually happening in the physical metals world. The daily statistics released by the exchange operators paint a picture not of a typical market rally driven by speculation and enthusiasm, but rather of something far more urgent and potentially destabilizing. What occurred during a single 24-hour period represents one of the most significant physical movements in recent market history. The sheer magnitude of metal that departed from secure warehouse facilities across multiple locations tells us that something fundamental has shifted in the dynamics between paper contracts and actual physical silver. This wasn't a gradual drift or slow reallocation of inventory. This was decisive action by major market participants who clearly believed that metal needed to be moved immediately and moved in size. The numbers themselves are staggering when you really stop to digest them. Nearly 3 million ounces of physical silver were physically removed from depositories in just one day. To put that in perspective, this represents thousands upon thousands of troy ounces being loaded onto pallets, secured in armored transportation, and driven away from the facilities that have historically served as the backbone of the exchange delivery system. This metal didn't just get reclassified on a spreadsheet or moved from one accounting category to another. It literally left the building, removed from the immediate supply that backs the pricing mechanism traders see on their screens every day. Breaking down the specific locations where this occurred reveals a coordinated pattern that suggests this wasn't random market activity. One major refinery and vault operator saw over 1 million ounces shifted out of the category that represents metal available for immediate delivery. This category is crucial because it represents the actual physical inventory that gives credibility to the paper market. When metal moves out of this classification, it signals that someone with significant resources has decided they want exclusive ownership and control over that silver, removing it from the pool that other market participants can access. This single move alone would be noteworthy, but it was just the beginning of what transpired that day. The same facility also experienced physical withdrawals exceeding 500,000 ounces. Combining these two movements means that in one location alone, well over 1.5 million ounces became unavailable to the broader market in a matter of hours. But this pattern wasn't isolated to just one vault. Another major secure logistics company, known globally for handling precious metals and other high-value assets, processed withdrawals of more than 600,000 ounces. Meanwhile, a depository that serves as a critical hub for both governmental and industrial silver needs saw similar withdrawals of just over 600,000 ounces, along with additional hundreds of thousands moved out of the registered classification. When you start adding up these individual vault activities, the total picture becomes impossible to ignore. Multiple facilities, all experiencing massive outflows on the same day, typically a quiet day of the week when metal movements tend to slow down, suggests coordinated intent rather than coincidence. The timing itself raises questions about what these metal owners knew or anticipated that made retrieving their physical holdings so urgent that it couldn't wait through the weekend. The overall registered inventory total, while still appearing substantial in absolute numbers at over 120 million ounces, must be viewed in the context of these withdrawal rates. Market observers who simply look at that headline number and conclude there's abundant supply are missing the critical dynamic of velocity. It's not just about how much metal exists in the system today, but how quickly that metal is being drained away. A bathtub might look full, but if water is rushing out faster than it's coming in, you need to focus on the drain, not the current water level. On the same day these massive physical movements occurred, we saw registered inventory drop by nearly 900,000 ounces. If this pace continues, if the system continues burning through registered metal at close to 1 million ounces daily while total withdrawals approach 3 million ounces, the mathematics becomes quite straightforward and somewhat alarming. The stockpile, regardless of its current size, has a finite lifespan measured not in years, but in weeks if the drain rate persists. What makes this situation even more complex is that not all of the registered inventory is truly available for purchase at current market prices. Much of this metal belongs to major financial institutions that maintain it for regulatory hedging purposes. These banks aren't in the business of selling their strategic reserves unless forced to do so. As inventory levels decline, these institutions will likely become increasingly protective of their remaining holdings, effectively reducing the actual float of metal available to new buyers to a fraction of the reported total. Meanwhile, the price action on that same day saw silver rally by more than $4, closing just 9 cents below a major round number that represents significant psychological resistance. This price movement wasn't occurring in a vacuum separate from the physical developments. The paper market was clearly sensing the tightness in physical supply, with traders bidding prices higher in search of a level that might stem the outflows. The fact that metal continued leaving even as prices surged suggests that buyers were willing to pay well above current market levels to secure physical possession. This brings us to a critical question about destination. Physical silver doesn't simply vanish into thin air. When millions of ounces leave warehouses, they're going somewhere specific for specific reasons. The answer to where becomes clear when examining price differentials across global markets. While silver in Western markets closed the week around $80 per ounce, the price in Asian markets, particularly in China, closed significantly higher at over $83. This $3 to $4 gap represents an enormous arbitrage opportunity that explains the motivation behind the vault raids. In commodity trading, price spreads between markets are typically measured in pennies or even fractions of pennies. When a spread of multiple dollars opens up, it signals market dislocation and creates overwhelming incentive for physical traders to exploit the differential. The mechanics are simple but powerful. Purchase silver where it's cheaper, transport it to where it's more expensive, and capture the difference as profit. When you're moving millions of ounces, even a $3 spread translates into millions of dollars in locked-in gains. For sophisticated trading operations with access to vault inventory and international shipping capabilities, this arbitrage is essentially free money. Buy the metal in New York at $79, spend perhaps 50 cents on insurance and transportation to fly it to Shanghai, and sell it for over $83. The profit margin per ounce might seem modest, but multiplied across the millions of ounces being moved, it generates substantial returns for very little risk. This is why the vaults are draining. It's not conspiracy or manipulation in the traditional sense. It's pure economic gravity. Capital flows to where it can earn the highest return, and right now, that means physical silver flows from west to east. The Shanghai premium creates what physicists would call a pressure gradient. The higher prices in Asia literally pull metal out of Western vaults through economic force. As long as this price differential persists, the drain will continue. And here's where it gets particularly interesting for those trying to manage this situation. If Western exchanges attempt to suppress prices to keep silver artificially low, they actually make the problem worse. A wider gap between Eastern and Western prices increases the profit margin for arbitrage traders, which incentivizes even more aggressive vault raiding. The exchanges are trapped in a paradox where keeping prices low accelerates the physical drain that threatens their viability. This explains why we saw such a substantial price rally. Even as some market participants might have preferred stability, the price increase wasn't speculative enthusiasm, it was defensive action. The system had to raise the bid price to slow the bleeding of physical metal. But even after a $4 rally, Western silver remains $3 cheaper than in Shanghai, meaning the arbitrage window is still wide open and the drain continues. Now you might wonder whether this flow could reverse if prices adjust. In a normal market, if one region becomes too expensive, suppliers would sell metal back to rebalance prices. But we're not operating in a normal market anymore due to recent policy changes. As of the beginning of this year, new export restrictions limit who can ship silver out of China. Only a few dozen state-approved firms have permission, and they operate under strict quotas. This means the metal market has become asymmetric. Silver can flow into China relatively freely, but it cannot flow back out. Once a bar of silver lands in Shanghai, it's effectively removed from Western financial markets permanently. This one-way flow has profound implications. Every ounce that leaves a vault in New York to satisfy Chinese demand represents a permanent reduction in Western available supply. That metal will either be consumed in industrial applications like solar panel manufacturing or stored in strategic reserves. It will never again be available to settle a contract on Western exchanges. We're watching a steady transfer of strategic physical assets from west to east, and this transfer is accelerating rather than slowing. The philosophical question underneath all of this is the difference between price and value. Price is what you pay in a transaction. Value is what you actually receive. Right now, Western markets seem focused predominantly on price, looking at $80 silver and thinking it's expensive relative to historical norms. Eastern markets appear focused on value, recognizing that silver is essential for energy infrastructure, electronics manufacturing, and industrial processes that cannot function without it. China understands that the value of silver extends far beyond its current dollar price. They're willing to pay premiums because they're securing critical resources before global competition intensifies. When you see silver trading above $83 in Shanghai, that's not a bubble or irrational exuberance. That's the true price in a market where physical delivery is the priority rather than an afterthought. The Western price of $79 represents the cost of a paper derivative that promises silver, but increasingly struggles to deliver actual metal. As physical inventory drains away, that paper price is being dragged upward toward the real physical price, whether it wants to go there or not. Looking at the leverage in the system reveals just how precarious the situation has become. Current open interest in silver contracts represents claims on roughly 700 million ounces of silver. The actual physical metal backing those claims amounts just over 120 million ounces. That's nearly a 6-to-1 ratio of paper claims to physical metal. In normal times, this works fine because most contract holders settle for cash rather than demanding delivery. But these aren't normal times. When there's a significant premium available for taking physical delivery and shipping to Asia, suddenly those paper contracts want to become real metal. If even 20% of contract holders decide they want physical delivery rather than cash settlement, that creates demand for 140 million ounces against an inventory of 123 million. The mathematics simply doesn't work. The system would default because there isn't enough metal to satisfy delivery demands. This leverage bomb sits underneath the market like unstable dynamite, and every day that physical drains continue brings us closer to potential detonation. There's an economic concept about consuming your capital to survive a temporary crisis, sacrificing long-term assets to get through a short-term challenge. That's what's happening as Western vaults are stripped to keep prices artificially suppressed for one more day. By allowing this inventory to drain, by letting arbitrage traders and commercial buyers remove metal to chase overseas premiums, the system is liquidating its strategic reserves. Each major withdrawal represents another piece of tangible wealth converted to satisfy paper obligations. Eventually, you run out of furniture to burn, and that's when the real crisis begins. The current price sitting just 9 cents below $80 is no accident. The market is coiled like a spring, pressing against resistance, waiting for the catalyst that pushes it through. The banks managing short positions tried desperately to keep the lid on below this psychological level to get through the weekend, but they couldn't stop the physical exodus. When Asian markets digest the inventory reports showing multi-million ounce withdrawals, when traders in Shanghai and Tokyo react to clear evidence that Western supply is draining, the response will be swift. The electronic markets that open Sunday evening will likely gap higher, potentially jumping past $80 in the opening minutes of trading. This kind of gap creates its own momentum because it traps short sellers who positioned below the breakout level. They wake up underwater with losses and no good exit except buying at higher prices, which pushes prices even higher. The resistance level that held prices down becomes the new support level, and once cleared, there's open territory above with no obvious ceiling except the next round number. Why does crossing $80 matter beyond being a nice round number? Because it's a signal that penetrates public consciousness. Headlines will read that silver broke through $80 on supply concerns. This brings in a new wave of buyers who weren't paying attention at $70, but suddenly want exposure because they see momentum. These new buyers enter a market that's already tight on physical supply, where dealers are sold out and vaults are draining. Their buying pressure hits an illiquid market and forces prices higher still as they bid against each other for available supply. The question becomes, who would sell silver at $80 or $85 in this environment? Retail investors who've held through the rally probably aren't selling their insurance policy right before the storm intensifies. Mining companies would rather wait for higher prices. Chinese buyers are accumulating, not distributing. So where does supply come from to satisfy new demand? It has to come from prices rising high enough to induce holders to part with metal they'd rather keep. That might mean $90. It might mean $100. It means wherever the pain point sits, where conviction wavers. The strategy moving forward is straightforward but requires discipline. Focus on the physical inventory reports rather than day-to-day price volatility. Check whether metal is still leaving the vaults, whether registered inventory continues declining. As long as the physical drain persists, the fundamental bull case remains intact. Price must rise to stop the bleeding because that's economic law. Selling physical silver prematurely in this environment means trading a scarce, tangible asset for currency that's being created in unlimited quantities. The swings will be violent as we move higher. There will be $5 down days designed to shake out weak hands. Don't let price action on screens override the fundamental reality of what's happening in vaults. What we witnessed with the nearly 3 million ounce raid represents a turning point. It proves that major players have lost confidence in paper promises and want actual bars they can touch and control. This is capital voting with actions rather than words. When the largest and most sophisticated market participants are removing collateral from the banking system and taking personal possession, they're expressing a view about counterparty risk and monetary stability. The run on the bank has begun, but instead of depositors lining up outside retail branches, it's armored trucks backing up to vault loading docks. The lines are forming quietly in the background, while most people watch price charts. Those who already hold physical silver are already inside the vault. The question is simply whether to maintain conviction as the system sorts itself out. Everything points toward prices needing to move substantially higher before equilibrium returns. The vaults are getting emptier every single day, and that's a trend that math says cannot continue indefinitely at current prices. What happens next will be determined by how high prices must rise to finally stem the physical outflow, and right now, $80 clearly isn't high enough.